Hello everybody, I'm delighted to be here today to talk about listing technology and other innovative companies with weighted voting rights structures on the main board of the Hong Kong Stock Exchange. Today's webinar is the first of 3 I'll be doing over the next week or so. The second webinar on December the 14th will cover secondary listings of tech and innovative companies under Chapter 19C and listing pre-revenue biotech companies under Chapter 8A. The final webinar on December the 16th will continue the pre-revenue biotech listing presentation and also cover listing mineral companies under Chapter 18. The listing rules for technology and pre-revenue biotech company listings have been in effect since the end of April 2018. Chapter 8A of the listing rules sets out the rules for tech companies with weighted voting rights structures, or WVRs as they're known. Chapter 19C provides for secondary listing tech and other innovative companies which are primary listed on specified qualifying exchanges, and importantly, provides a route to secondary listing for Chinese tech companies, which paved the way for the secondary listing of US-listed Chinese tech companies Alibaba, NetEase, and Baidu, whose weighted voting rights prevented them from primary listing in Hong Kong under the pre-April 2018 listing regime. Chinese companies in traditional sectors such as property remain prohibited from secondary listing in Hong Kong. The rules for listing biotech companies that are unable to meet the financial tests of Chapter 8 are set out in Chapter 18A of the listing rules. Meanwhile, Chapter 18, which sets out the requirements for listing mineral companies, was updated in June 2010 to provide clarity for listing applicants. Prior to this, natural resources companies seeking to list in Hong Kong had to negotiate with the exchange on a case-by-case basis pretty much. The amendments have since seen a number of mineral companies listing in Hong Kong. The 2018 listing rule reforms have, as intended, reinvigorated the Hong Kong Stock Exchange, enabling it to reclaim its role as the world's top exchange for IPO fundraising in 2018, raising IPO funds of $36.9 billion and in 2019 with $37.2 billion in IPO funds raised. As for 2020, Hong Kong has seen a strong third quarter and is currently in place in terms of IPO fundraising in third place, with Shanghai and Nasdaq set to take first and second. A number of listings in 2020, as at the end of August 2020, have been Chinese tech and biotech companies, 99 listings, representing 23% of Hong Kong's total market cap and 15% of its average daily trading volume. And it's projected that Hong Kong will surpass Nasdaq as the top biotech listing hub in the next 5 to 10 years. As I'll talk about in more detail shortly, prior to the 2018 listing regime changes, Hong Kong was missing out on the new generation of Chinese tech and biotech company listings amid competition from the New York Stock Exchange and Nasdaq. Today, the Hong Kong Exchange also faces competition from the mainland Chinese stock exchanges, particularly from Shanghai's Nasdaq-style Star Market and Shenzhen's HKEx platform. The latest figures from KPMG as at the 22nd of September 2020 show that the Shanghai Stock Exchange was the world's top IPO fundraising market in the first 3 quarters of 2020, with IPO funds raised of US $38.2 billion, ahead of Nasdaq with US $31.1 billion, the Hong Kong Stock Exchange with $23.4 billion, the New York Stock Exchange with $21.7 billion US dollars, and the Shenzhen Exchange with IPO funds raised of $10.5 billion US dollars. In May 2017, the Hong Kong market was dominated by low-growth companies in traditional sectors. Financial and property sector companies accounted for 44% of the Hong Kong Exchange's market cap. In the 10 years to 2017, new economy companies made up only 3% of Hong Kong's Stock Exchange's market cap, compared to 60% for Nasdaq, 47% for the New York Stock Exchange, and 14% for the London Exchange. That changed with the listing rule changes in April 2018, which have made Hong Kong a hub for listing technology firms and the listing venue of choice for Chinese tech companies. Tech companies now dominate the exchange's main board and accounted for over 33% of its market cap at the end of June this year. 163 tech companies were listed on the main board as at 30th of June 2020, compared to 137 at the 217 year-end. Tech stocks accounted for 27.6% by value of shares traded on the Hong Kong Exchange in the first half of 2020, compared to 18.5% in 2018. The largest IPOs on the Hong Kong Exchange are those of Chinese tech companies. In 2018, China Tower Corporation's 58.8 billion Hong Kong dollar IPO and Xiaomi Corporation's 42 billion Hong Kong dollar IPO were the largest IPO fundraisings on the exchange of that year. However, having missed out on Alibaba Group's 2014 IPO, Hong Kong reaped the benefits of its 100+ billion Hong Kong dollar secondary listing under Chapter 19C and the world's second largest listing of 2019, and the Hong Kong Stock Exchange's third largest listing to date. The Hong Kong Stock Exchange's third place ranking among global exchanges in the first 3 quarters of 2020 is largely attributable to homecoming US-listed Chinese companies' secondary listing in Hong Kong. 7 companies secondary listed in the period, raising 102 billion Hong Kong dollars in total, approximately 48% of the total IPO funds raised on the Hong Kong Exchange in the period. Meanwhile, 21 pre-revenue biotech companies have listed under Chapter 18A, raising over 53 billion Hong Kong dollars. There are a diverse range of pre-revenue biotech companies, which include biopharmaceuticals and medtech companies. Several listed biotech companies have also conducted successful post-listing fundraisings. Innovent Biologics, for example, raised 4.8 billion Hong Kong dollars in 2 rounds of share placings. Both Beijing, the first NASDAQ-listed pharmaceutical firm to dual list in Hong Kong, and Innovent have received approval to upgrade their listing status from Chapter 18A to a general listing, as they've now satisfied the revenue and market capitalization test for listing under Chapter 8 of the main board listing rules. Turning now to weighted voting rights. Looking first at the requirements of Chapter 8A for listing tech and other innovative companies with weighted voting rights structures, Chapter 8A essentially provides an exception for tech companies from the listing rules' one share, one vote principle. Companies with weighted voting rights structures typically have dual class stocks, where the company's shareholders own Class A shares carrying 1 vote per share, while the founders and management hold Class B shares carrying multiple votes per share. Prior to the 2018 listing rule changes, the listing rule's one share, one vote principle prevented companies with weighted voting rights structures or similar from listing. This, however, proved problematic because weighted voting rights structures are commonly adopted by tech companies which need to raise large amounts of capital, but whose founders want to retain control and be able to pursue their vision for the company with a reduced shareholding. Arguments in favor of weighted voting rights structures are that they allow founders to fend off hostile takeover bids and protect the company from the short-term focus of institutional investors. Many of the new breed of tech giants, including Facebook, Alibaba, and Baidu, have adopted the structure. Hong Kong's prohibition of weighted voting rights structures and similar structures meant that the new Chinese tech companies with the highest growth prospects couldn't list in Hong Kong, historically the preferred offshore listing venue for Chinese companies. They were also prevented from listing in China and listed instead on the New York Stock Exchange and NASDAQ. Both these exchanges have allowed weighted voting right listings for many years for all companies, irrespective of sector. The impetus for change was the Hong Kong Stock Exchange losing the biggest IPO in history, Alibaba Group's $21.8 billion IPO, to the New York Stock Exchange in 2014. A long and contentious debate on weighted voting right listings ensued, involving several public consultations before the listing rules were finally changed in 2018. US-China trade tensions and increased scrutiny of Chinese tech companies are also encouraging Chinese tech companies to prefer a Hong Kong listing over listing in the US. Several sizable Chinese groups have recently spun off unicorn subsidiaries. Ping An Insurance spun off Ping An Healthcare and Technology in Hong Kong in 2018, and both JD.com and NetEase, which have recently secondary listed in Hong Kong, have said that they will spin off their subsidiaries in Hong Kong within 3 years. That trend could be cemented further if the US implements proposals for delisting Chinese companies which refuse to submit their auditing records for examination by the US Public Company Accounting Oversight Board. US legislation implementing the proposal in the form of the Holding Foreign Companies Accountable Act was passed on the 2nd of December 2020. The US regulators have long complained about the Big Four accounting firms refusing to provide their audit papers of Chinese companies listed in the US in breach of the requirements of the Sarbanes-Oxley Act 2002 on the basis that to do so would breach China's state secrecy laws, which are broadly defined. Chinese securities laws also require the manuscripts of work performed in China on an overseas listing of securities to be stored in China. Under the new law, trading in a Chinese company's shares on any New York Stock Exchange or over-the-counter market will be prohibited if the company fails to comply with US regulatory and audit standards and information sharing requirements. The Hong Kong Stock Exchange is also targeting China's pipeline of unicorns and was expected to benefit this year from the dual listing of Ant Group, Alibaba's financial services subsidiary, and supposedly the world's most valuable unicorn, on the Hong Kong Exchange and the Shanghai Star Market. The Ant Group listing, expected to be the world's largest ever fundraising, was however halted on the 3rd of November 2020 after material changes in the regulatory stance on financial services. SenseTime Group, China's largest AI unicorn and the world's most valuable AI startup valued at $7.5 billion is said to be exploring a dual listing in Hong Kong and China, although it hasn't finalized the timeline. Recent reports, however, suggest that a dual listing will take place within the next 3 years. As I'll discuss later, the Hong Kong Stock Exchange published long-awaited proposals in January 2020 to expand its regime for listing weighted voting right companies to allow corporate shareholders to hold weighted voting rights, which would pave the way for more than 38 US-listed Chinese tech companies, including Tencent Music, to list in Hong Kong. Currently, only individuals can hold weighted voting rights shares. The exchange published consultation conclusions on the 30th of October this year, saying that while a majority of respondents agreed with the proposal to allow corporates to benefit from weighted voting rights, the exchange decided that more time is needed for the market to develop a better understanding of Hong Kong's regulatory approach to listed companies with weighted voting rights structures and to monitor the operation of Chapter 8A, which permits individuals to benefit from weighted voting rights. The exchange has, however, decided to treat Greater China issuers that are controlled by corporate weighted voting right beneficiaries as at the end of October this year, and that are primarily listed on a qualifying exchange, that's the New York Stock Exchange, NASDAQ, or the premium segment of the London stock market, on or before the 30th of October 2020 in the same manner as grandfathered Greater China issuers for the purposes of Chapter 19C. So that will allow qualifying Greater China issuers to secondary list on the exchange with a corporate weighted voting rights structure, even if it doesn't comply with the listing rule requirement for weighted voting rights structures for primary listing applicants under Chapter 8A. The listing rules define weighted voting rights as the voting power attached to a share of a particular class that's greater than the voting power attached to an ordinary share or another governance right or arrangement which is disproportionate to the beneficiary's economic interest in a listed company's shares. Only companies with share-based weighted voting rights structures, that's where the superior voting powers are attached to the company's shares, are allowed to list in Hong Kong. The stock exchange won't list companies with a board of directors-based weighted voting rights structure, which gives certain persons control of the board, which is disproportionate to their equity stake in the company. That's under Chapter 8A. Primary listing applicants with a weighted voting rights structure must demonstrate additional suitability criteria, which are set out in Guidance Letter 93/18 of the Exchange, called Suitability for Listing with a Weighted Voting Rights Structure. In order to be considered suitable for listing, a weighted voting rights structured company needs to have certain characteristics. Firstly, the listing applicant must be an innovative company, which is demonstrated by the company having one or more of certain characteristics. Its success is attributable to the application of new technology, innovation, and/or a new business model to its core business, which differentiates the listing applicant from existing players. Secondly, research and development significantly contributes to its expected value and comprises a major activity and expense. Its success is attributable to its unique features or intellectual property, and/or it has an outsized market capitalization, intangible net asset value relative to its tangible asset value. What is considered to be innovative may, of course, change over time. A weighted voting rights structured company with an innovative business model may qualify for listing, but once that business model becomes widely adopted, it may cease to be innovative, so that weighted voting rights structured companies adopting the same business model in the future may not necessarily qualify for listing. The superficial application of new technology to an otherwise conventional business won't satisfy the suitability criteria. For example, where a retail business just develops an online sales platform, this would not be suitable for listing with a weighted voting rights structure unless it could demonstrate other distinctive features. The success of the company. The listing applicant is required to have a track record of high business growth, which can be objectively measured by operational metrics, for example, business operations, users, customers, unit sales, revenue, profits, and/or market value as appropriate. The high growth trajectory should also be expected to continue. Each weighted voting right beneficiary must have been materially responsible for the business's growth through their skills, knowledge, and/or strategic direction in circumstances where the company's value is largely attributable or attached to intangible human capital. The weighted voting right beneficiaries must be individuals who have an active executive role within the business and have materially contributed to the business's growth. Each weighted voting right beneficiary must be a director of the company when it lists on the Hong Kong Stock Exchange. The listing applicant must have previously received meaningful third-party investment, that's more than just token investment, from one or more sophisticated investors who are still investors at the time of the IPO. There are no bright-line tests for determining who is a sophisticated investor or what is a meaningful investment. Guidance Letter 93/18 defines sophisticated investors as investors the exchange considers to be sophisticated by reference to factors including their net assets or assets under management, relevant investment experience, and their knowledge and expertise in the relevant field. In its consultation conclusions on the weighted voting right listing rule changes, the exchange said that in determining whether an investment is meaningful, it will examine the nature and timing of the investment, the amount invested, and the size of the stake taken up. Guidance Letter 93/18 requires sophisticated investors to retain 50% of their investment at listing for at least 6 months after listing, although there are exceptions for de minimis investments by specific investors where the main investors comply with this requirement. Listing applicants that are spin-offs from a parent company are not normally required to demonstrate that they have received third-party investment. The guidance letter notes that the stock exchange exercises its discretion to determine a weighted voting rights structured listing applicant as being suitable to list sparingly, and that it considers all relevant circumstances in determining a listing applicant's suitability. The suitability factors listed in the guidance letter are not exhaustive or binding. Moreover, there's no guarantee that a company which demonstrates these characteristics will be considered suitable for listing, as the exchange retains a discretion to reject a listing application. The exchange may reject a listing application where the applicant's weighted voting rights structure represents an extreme case of non-conformity with governance norms. For example, if the ordinary shares carried no voting rights at all. Listing applicants with weighted voting rights structures have to meet a market cap requirement of at least 40 billion Hong Kong dollars at listing, or a market cap of at least 10 billion Hong Kong dollars at listing, and at least 1 billion Hong Kong dollars of revenue in the most recent audited financial year. The exchange only allows new listing applicants to list with a weighted voting rights structure. It has a discretion to reject listing applications from companies which have tried to circumvent or avoid this rule, for example, by delisting as a conventional company and then applying to list as a weighted voting right company. Listed companies can't increase the proportion of weighted voting right shares from the proportion in issue at the date of listing. A weighted voting right company listed under Chapter 8A is also subject to restrictions on further issues of shares with weighted voting rights. It can only allot, issue or grant shares carrying weighted voting rights in a pro rata offer to all shareholders, a pro rata issue of securities to all shareholders by way of scrip dividends, or a stock split or other capital reorganization which will not increase the proportion of shares holding weighted voting rights. The exchange's prior approval is required in each of these situations. If a weighted voting right beneficiary doesn't take up any weighted voting right shares or rights to weighted voting right shares in a pro rata offer, the shares or rights not taken up can be transferred to another person, but the transferred rights must only entitle the transferee to an equivalent number of ordinary shares. Where a listed company reduces the number of its issued shares, the weighted voting right beneficiaries will be required to reduce their weighted voting rights proportionately if the reduction in issued shares would cause an increase in the proportion of shares carrying weighted voting rights. Listed companies are also prohibited from changing the terms of a class of shares carrying weighted voting rights to increase the weighted voting rights carried by that share class. However, they can reduce the weighted voting rights carried with the exchange's approval, provided they comply with relevant legal requirements. Currently, weighted voting right beneficiaries must be natural persons who must be directors at the time the company lists on the Hong Kong Stock Exchange. As directors, they owe fiduciary duties to the company under Listing Rule 3.08. As I've already mentioned, under the suitability requirements for weighted voting right beneficiaries set out in Guidance Letter 9318, weighted voting right beneficiaries must be individuals with an active executive role within the business who have materially contributed to the growth of the business through their skills, knowledge, and/or strategic direction. The listing rules prescribe certain situations when a person's weighted voting rights will cease. These are where the weighted voting right beneficiary dies or ceases to be a director, or the stock exchange deems the person to be incapacitated for the purpose of performing their duties as a director, or to no longer satisfy the listing rules requirements for directors. These event-based sunset provisions prevent weighted voting rights from continuing indefinitely. At the time of listing, a company's weighted voting right beneficiaries must collectively beneficially own at least 10% of the underlying economic interest in its total issued share capital. This requirement does not continue after listing. A shareholding below 10% may be accepted by the stock exchange on a case-by-case basis if the interest represents a very high amount in absolute dollar terms. For example, where the listing applicant's expected market cap is above 80 billion Hong Kong dollars. A weighted voting right beneficiary in any vehicle through which the beneficiary holds shares carrying weighted voting rights are deemed to be connected persons and core connected persons of the listed company, if they aren't already under other analyses. Questions were raised in the consultation exercise as to how a listing applicant with a weighted voting rights structure can comply with the listing rules ownership, continuity and control requirements. The exchange noted in response that a listing applicant may be able to rebut a presumption that there's been a change in ownership, continuity and control by demonstrating that there was no material change in influence on management, notwithstanding the technical change in controlling shareholders resulting from an increase in voting power conferred by the weighted voting rights structure. Weighted voting rights can only attach to a class of shares, and that class is not eligible for listing. The stock exchange expects only one share class to carry weighted voting rights. The exchange will consider listing applications from companies with more than one share class holding weighted voting rights on a case-by-case basis, where the company's particular circumstances justify having multiple share classes and the weighted voting rights structure is not an extreme case of non-conformity with governance norms. Weighted voting rights can only confer enhanced voting power on resolutions tabled at general meetings, but cannot confer enhanced voting power on matters that the listing rules require to be decided on a one vote per share basis. With the exception of enhanced voting rights, the rights attached to weighted voting rights shares must be the same as the rights attached to the company's ordinary shares. The listing rules impose a limit on the voting rights that can attach to weighted voting rights shares. Weighted voting right beneficiaries must not be entitled to more than 10 times the voting power of ordinary shares. In addition, the company's non-weighted voting rights shareholders must be entitled to cast at least 10% of the votes that are eligible to be cast on resolutions at the company's general meetings. Non-weighted voting rights shareholders holding 10% or more of the voting rights on a one vote per share basis must be able to convene an extraordinary general meeting and to add resolutions to the meeting agenda. The listing rules set out a number of resolutions which must be passed on a one vote per share basis, with any weighted voting rights being disregarded. These are resolutions relating to changes to the company's constitutional documents or to the rights attached to any class of its shares, the appointment or removal of any independent non-executive director or removal of the company's auditors, and a resolution on the voluntary winding up of the company. Non-weighted voting right holders can't remove or modify weighted voting right structures. The note to Listing Rule 8A24 provides that the weighted voting rights attached to a share class may only be varied with the consent of the holders of that share class, as specified in the regulations or laws to which the listed company is subject. If there's no requirement for that approval under the relevant regulations or laws, the exchange will require the company to include such approval in its constitutional documents to the extent not prohibited under the laws of its jurisdiction of incorporation. The weighted voting rights attached to a weighted voting right beneficiary's shares cease if the weighted voting right beneficiary transfers their beneficial ownership of or economic interest in the weighted voting right shares to another person, or transfers control over the voting rights attached to their shares to a third party. A limited partnership, trust, private company or other vehicle is allowed to hold weighted voting rights shares on behalf of the beneficial owner, provided that the arrangement doesn't circumvent the restriction on transferring weighted voting rights shares. Where a vehicle holding weighted voting rights shares no longer complies with this rule, the beneficiary's weighted voting rights will cease. In the consultation conclusions on the weighted voting right listing rules, the exchange clarified that weighted voting rights can be held through a partnership structure if the terms of the partnership stipulate that the voting rights attached to the shares are solely dictated by the weighted voting right beneficiary. Also, if weighted voting rights are held through a trust, this will not cause the weighted voting rights to terminate, provided the purpose of the trust is for estate or tax planning purposes, and the weighted voting right beneficiary keeps an element of control of the trust and any immediate holding companies, or, if not permitted in the relevant tax jurisdiction, retains a beneficial interest in the weighted voting rights shares. Weighted voting rights shares can be held through a private company or other vehicle if the weighted voting right beneficiary wholly owns and controls the company or other vehicle at all times. These requirements are aimed at ensuring that only individuals with ongoing responsibility for the listed company's performance are entitled to weighted voting rights. Since weighted voting right beneficiaries have to meet the competence and character requirements for directors under the listing rules and will owe fiduciary duties to the company under the listing rules, the company's shareholders should be assured that the company will be managed for the benefit of the company and its shareholders as a whole. In response to suggestions that the exchange should permit stock borrowing of weighted voting rights shares, the exchange noted in the consultation conclusions that it was concerned that allowing stock borrowing of weighted voting rights shares could result in a change of control of the listed company at the time when the weighted voting right shares are lent out and returned. It noted, however, that it may consider granting a waiver in exceptional circumstances where a listed company can justify the need for stock borrowing using weighted voting rights shares. Where weighted voting rights shares are converted into ordinary shares, the conversion has to be on a one-to-one basis. The listed company will need to obtain the exchange's approval for the listing of the shares that are issuable on conversion of the shares carrying weighted voting rights. A weighted voting rights structured company will have a stock marker W at the end of its stock name. The company is required to prominently disclose a warning, a company controlled through weighted voting rights, on the front page of its corporate documents, including its listing document, financial reports, circulars, notifications, and announcements. Weighted voting right companies must also describe their weighted voting right structure, the rationale for it, and the risks for shareholders in their listing documents and financial reports. Weighted voting right beneficiaries must also be identified in listing documents and interim and annual reports. Weighted voting rights structured companies must also disclose in their listing documents and interim and annual reports the impact of a potential conversion of weighted voting rights shares into ordinary shares on the share capital, as well as all circumstances in which the weighted voting rights will cease. Companies with weighted voting rights structures are required to establish a corporate governance committee made up only of INEDs and chaired by an INED. The Corporate Governance Committee's terms of reference must include those set out in Code Provision D31 of the Corporate Governance Code and Corporate Governance Report in Appendix 14 to the Listing Rules, and additional terms of reference set out in Listing Rule 8A30. These additional provisions require the Corporate Governance Committee to review and monitor whether the listed company is operated and managed for the benefit of all its shareholders, and to provide annual confirmations that the weighted voting right beneficiaries have been directors throughout the year and that nothing has occurred to terminate any weighted voting rights. The Corporate Governance Committee's annual confirmations must also state that the company has complied with the various restrictions on weighted voting right companies, including the restrictions on further issues of shares with weighted voting rights, the requirements applicable on reducing the number of its listed shares, the requirements for weighted voting rights to cease in certain circumstances, and for weighted voting rights to be disregarded on resolutions required to be passed on a one vote per share basis. The Corporate Governance Committee must also be responsible, under its terms of reference, for reviewing and monitoring the management of conflicts of interest and making recommendations to the board where there is a potential conflict of interest between any weighted voting right beneficiary on the one hand and the listing company or any of its subsidiaries or shareholders on the other. The Corporate Governance Committee must also have responsibility for monitoring and reviewing the risks related to the company's weighted voting rights structure, including connected transactions between any weighted voting right beneficiary and the listed company, its subsidiaries or shareholders. The committee is also required to make a recommendation to the board on any relevant connected transaction. Companies with weighted voting rights structures are required to comply with the Corporate Governance Code's requirements for maintaining an ongoing dialogue with their shareholders, as set out in Section E under Listing Rule 8A35. The company's Corporate Governance Committee is also tasked with ensuring the company's compliance with that listing rule and seeking to ensure effective and ongoing communication between the company and its shareholders. The Corporate Governance Committee of a weighted voting right company must report on its work at least on a half-yearly and annual basis. Its reports must cover all areas of its terms of reference and must disclose on a comply or explain basis its recommendations to the board on conflicts of interest, connected transactions, and in relation to the appointment or removal of a compliance advisor. Listed companies with a weighted voting rights structure are required to appoint a compliance advisor on a permanent basis. The Corporate Governance Committee is responsible for making recommendations to the board regarding the appointment or removal of the compliance advisor. According to the consultation conclusions, the Corporate Governance Committee may invite members of management to attend Corporate Governance Committee meetings as required. The corporate governance report produced by a listed company with a weighted voting rights structure has to comply with Appendix 14 of the Listing Rules and must include a summary of the work of the Corporate Governance Committee with regard to its terms of reference and should disclose any significant subsequent events up to the publication date of the half-year or annual report if possible. Chapter 8A mandates certain provisions of the Corporate Governance Code and Corporate Governance Report governing the rules of INEDs. Weighted voting rights structured companies must establish a nomination committee responsible for making recommendations to the board on the nomination, appointment and reappointment of directors, including INEDs, under Code Provision A5, 2, B and D. Listing Rule 8A28 requires the nomination committee to be chaired by an INED, and in compliance with the Corporate Governance Code, it should be made up of a majority of INEDs. Chapter 8A also requires the INEDs of a weighted voting right company to retire by rotation at least once every 3 years, although INEDs are eligible for reappointment at the end of the 3-year term. Listed companies with weighted voting rights structures are required to engage a compliance advisor permanently from the date of listing. The company must consult with and, where necessary, seek advice from its compliance advisor in the usual circumstances set out in Listing Rule 3A22 and on any matters related to the weighted voting rights structure. Transactions in which any weighted voting right beneficiary has an interest and where there is a potential conflict of interest between a weighted voting right beneficiary on the one hand and the listed company, any of its subsidiaries and or shareholders as a group on the other. A listing applicant's directors, including those holding weighted voting rights, senior management and company secretary, have to undergo training on the weighted voting right listing rules and the risks associated with the company's weighted voting rights structure. And the applicant will have to give a confirmation to that effect to the stock exchange. On listing, the weighted voting right beneficiaries are required to give an undertaking to the listed company that they will comply with the relevant weighted voting right safeguards. Companies must give effect to the safeguards under Chapter 8A by including them in the Articles of Association or equivalent document. This allows shareholders to take civil action against the company in order to enforce the weighted voting rights safeguards. Under the current regime, weighted voting right beneficiaries must be natural persons, that's individuals. Responding to calls for corporates to be allowed to hold weighted voting rights, the exchange originally proposed to launch a consultation on the issue by the 31st of July 2018. This was deferred, and the exchange published its consultation paper on corporate weighted voting right beneficiaries as at the 31st of January 2020, seeking feedback on a proposal to allow corporate entities to benefit from weighted voting rights, subject to additional conditions and investor protection measures. As I touched on earlier, the consultation conclusions have since been released, in which the exchange decided not to proceed with the proposal at this time, but that it would treat Greater China issuers that are innovative companies with corporate weighted voting right beneficiaries and primary listed on a qualifying exchange as at the end of October this year in the same manner as grandfathered Greater China issuers for the purposes of Chapter 19C, paving the way for a number of Chinese tech companies primary listed on the New York Exchange or NASDAQ to pursue secondary listings in Hong Kong. Being treated as a grandfathered Greater China issuer would mean that the company would be eligible for waivers from many of the listing rules requirements, including the notifiable and connected transaction requirements. They would also be able to list with their existing corporate weighted voting rights structures in place, even if they don't comply with the requirements for weighted voting rights structures of primary listing applicants under Chapter 8A. To be eligible for listing, the Greater China issuer will have to have a market cap of at least 40 billion Hong Kong dollars or of at least 10 billion Hong Kong dollars if it has 1 billion Hong Kong dollars of revenue for its most recent audited financial year. It will also need to be controlled by a single corporate weighted voting right beneficiary or a group of corporate weighted voting right beneficiaries acting in concert, which is the company's largest shareholder in terms of voting power and controlling at least 30% of the voting power. The exchange also said that it plans to consult on normalizing the eligibility requirements applying to Greater China issuers that don't have weighted voting rights structures and seek secondary listings under Chapter 19C. It's hoped that this will be revisited in the near future, as allowing corporate weighted voting right beneficiaries would significantly increase the number of mainland companies in the emerging and innovative sector which are eligible to list on the Hong Kong Stock Exchange. The exchange's consultation paper noted that mainland emerging and innovative companies with corporate weighted voting right beneficiaries have listed in the US in recent years. Examples include Yodu, Tencent Music, and Huya, which all listed in 2018 or 2019 and had a market cap at listing of above 10 billion Hong Kong dollars, the threshold for weighted voting right listing in Hong Kong. Between 2010 and November 2019, 42% of mainland companies with weighted voting right structures that listed in the US had corporate weighted voting right beneficiaries. These companies represented 48% of the total IPO funds raised by mainland companies with weighted voting rights structures. 42 of the mainland's 50 largest unlisted unicorn companies have well-established corporate shareholders. These 42 unicorn companies had a combined market value of $540 billion US dollars, equivalent to 12% of the capitalization of the Hong Kong securities market at November 2019. While the proposal is somewhat shelved for now, let's take a look at the original proposal in a bit of detail. The exchange proposed that a corporate entity should be eligible to hold weighted voting rights if it or the company of which it's a wholly owned subsidiary satisfies certain additional suitability and eligibility criteria on the date of listing and meet continuing requirements on an ongoing basis. In order to be considered suitable, it was proposed that a corporate weighted voting right beneficiary should be an innovative company. That's a company meeting the criteria for companies listing with a weighted voting rights structure, as set out in paragraph 4.2 of Guidance Letter 9318, or have a track record of investments in and contributions to innovative companies. Also, the corporate weighted voting right beneficiary would be required to have held an economic interest of 10% in and been materially involved in the listing applicant's business for 2 financial years prior to the listing application. It would also have to increase that economic interest to 30% at the date of listing. It was also proposed that the corporate weighted voting right beneficiary's contribution to the listing applicant must be of a type that's not easily replicated or substituted. Financial investments or non-financial contributions, such as know-how or strategic advice, wouldn't be sufficient to allow a corporate shareholder to hold weighted voting rights. Private equity investors, for example, could not hold weighted voting rights. A corporate weighted voting right holder would also have to be able to demonstrate that it owns and operates an ecosystem at listing and on an ongoing basis that benefits the listing applicant. A key requirement for the ecosystem is that it comprises a community of companies, including the listing applicant and other components, which could be business units of the corporate shareholder, user or customer bases, applications, programs, or other technological applications, that is grown and co-evolved around a technology or know-how platform or a set of core products or services owned or operated by the corporate weighted voting right beneficiary. The components of the ecosystem, including the listing applicant, would need to benefit from and contribute to the ecosystem by sharing data, users, and/or technology such as software. The ecosystem would also have to have attained a meaningful scale as measured by reference to indicators such as the number and technological sophistication of its components, size of its user base, extent and frequency of cross-interaction between the users or customers of different components. The ecosystem's core components and the listing applicant would need to be controlled in substance by the corporate weighted voting right beneficiary. And finally, the listing applicant's growth and success would need to be materially attributable to its participation in and co-evolvement with the ecosystem. And there should be an expectation the listing applicant will continue to benefit materially from being part of that ecosystem. A corporate weighted voting right beneficiary would need to be primary listed on the Hong Kong exchange or on a qualifying exchange, and would need a minimum market cap of 200 billion Hong Kong dollars. The proposal also included a limit on the size of the listing applicant whose market cap must not be more than 30% of that of the corporate weighted voting right beneficiary. While the weighted voting rights held by an individual are capped at 10 times the voting power of the company's ordinary shares, the weighted voting rights held by a corporate beneficiary would be capped at 5 times the voting power of the company's ordinary shares. The proposed continuing requirements for corporate weighted voting right beneficiaries were that they should have at least one corporate representative on the board of directors of the listed company, and they must remain listed on the Hong Kong exchange or a qualifying exchange. They must also continue to own a 30% economic interest in the listed company. Weighted voting rights held by a corporate beneficiary would lapse after a time-defined sunset period of no more than 10 years, but could be renewed for successive periods of no more than 5 years with the approval of the company's independent shareholders. Weighted voting rights held by a corporate beneficiary would lapse permanently if its contribution to the weighted voting right issuer is substantially terminated or materially disrupted or suspended for 12 months or more. Where there's any breach of the requirements of Chapter 8A, the stock exchange would have the discretion to direct a trading halt, suspend dealings, or cancel the company's listing, impose disciplinary sanctions, or withhold approval for a listing application on the issue of a circular. So that more or less brings me, I think, to the end of this 1-hour webinar. Thank you again for joining me today. And if you have questions, as I mentioned, please email me on juliacharlton@charltonslaw.com. I'll do my best to get back to you. And as I mentioned earlier, this is part 1 of a 3-part webinar series. Part 2 will be next Monday on the 14th of December, and will cover secondary listings of innovative companies and listing biotech companies on the Hong Kong Stock Exchange. You're most welcome to join us. You can find the link to register on our website. And for those of you who've already registered, I'll see you on Monday. Thank you and have a great weekend.